Interest payments on mortgages were up 26% year over year last month, and that accounts for a significant chunk of Canada's consumer price index. For our next guest, though, says that this is misleading. To explain why, joining us is Benjamin Tal, Deputy Chief Economist at CIBC Capital Markets. Benny, this was an interesting point that jumped out of the CPI data, this big jump, and it is having an influence on the overall number.
In a big way, absolutely, and we have to look at it and see if it makes sense or not. The Bank of Canada is raising interest rates to fight inflation, which means that interest payments on mortgages are rising, which is a big part of the inflation story today, as you suggested, rising by 26%. This is big because you might suggest that the rising interest payments is not exactly inflationary. It's actually disinflationary because it's slowing down the economy. In addition, remember, in many cases from variable rate mortgages, as we discussed in previous occasions, the actual payment is fixed. What rises is interest payments, while principal payments goes down. But guess what? Principal payments are not part of the CPI. Interest payments are part of the CPI. So it's not fair, really, because you're counting only what's rising, not what's falling. And therefore, what you want to do is to eliminate interest payments from the calculation to get the real sense of inflation. And when you do that, you see that actually inflation is lower by 0.8% on all item basis. And actually, if you do it on a month-over-month basis, on core inflation, guess where we are? We are at 2% annual rate, which is, by the way, the target.
Is there something better that should be included to have that measurement of housing in there? You know, if you're not talking about the interest cost, is there a different cost or alternative that would be better?
Yes, it's very complicated because in the US, it's very different than Canada. In Canada, housing inflation or shelter is a function of many things, like the cost of building a new house, the commission that you pay to real estate brokers, interest payments, as we suggested. All those forces are there. In the US, it's all about rent. Rent is 40% of core inflation in the US. Why? Because they say, okay, if you are a renter, what's your price? Rent, fine. If you are a homeowner, what is your cost? And they say the following, listen to this, they said, let's assume that you rent your house to yourself. How much are you going to pay? Rent. And therefore, rent is 40% of core CPI. Now, rent in the US, and that's important, is rising by 7-8%, which is a major factor contributing to overall CPI. But if you look at the flow of new leases, it's basically zero inflation. So every day that passes, more of the flow, zero, gets into the stock, which is 7-8%. This is not a prediction. It's a given that rent inflation in the US, 40% of core CPI will be going down. That's a major disinflationary force. We don't have the same story in Canada. Rent is part of the calculation, and it's actually rising, but it's a very small part. As I suggested, interest payments is a big part, and it should not be there. At the minimum, if you have interest payments, you have to also have to have principal payments, but it's not going to happen. So I said, at the minimum, eliminate interest payments from the story and get the precise story.
Would the Bank of Canada consider doing something like that, do you think? Actually changing the makeup of CPI?
No, I don't think they will do that, but they can do the math and say, okay, let's see what the real CPI is as opposed to what we publish, what Stats Canada publishes. The issue is that this number is impacting the psyche of consumers and therefore inflation expectations, what the Bank of Canada is fighting against. So the Bank of Canada might realize that maybe the overall number is overstating inflation, but at the same time, they cannot change their methodology, and that's the tricky part. And therefore, that can impact inflation expectations, and that's the reason we are talking about it, to maybe talk about the situation, educate people about what you see in the newspapers is not exactly the headline, is not exactly what's happening. You have to go deeper and see what's in there to get a sense of what's really happening.
I mean, they do have these, these other measures, stripping out this or that or what have you. You could just make another one that strips out mortgage interest costs, don't you think?
Well, yes, we used to have one measure of inflation and then two measures. And then they say, let's simplify it. And how do you simplify? You add 3 more measures.
Right.
So it's not very simple anymore. We don't know what we are looking at. Some of them were not very accurate in the past, that to revise them. So it's a bit complicated. It's a very multidimensional story, the inflation story, but at the same time, we have to understand what's there. And at this point, with interest payments being the biggest item in terms of a year-over-year rate of growth, contributing to inflation, we have to understand that it's not really inflationary.
The Bank of Canada is going to be releasing its summary of deliberations tomorrow. Will there be anything in particular that you're looking out for within those minutes, essentially, of their last meeting?
Yes, it's going to be very interesting because we want to see to what extent the Bank of Canada is realizing that more pain is coming as far as the interest rates are concerned, and to what extent they should stop now. I believe that the Bank of Canada is already a bit overshooting and should stop at this point. This is our forecast. At the same time, there is a risk that they will continue to raise interest rates because inflation is still elevated. And that's something that I would like to really listen to and watch what the Bank of Canada is telling us, because I think that the risk of overshooting is a major risk. Another factor is to what extent what's happening in the US. The banking situation in the US, as you discussed just 2 minutes ago, is impacting the psyche of the Bank of Canada. To what extent it's doing the Bank of Canada's job, because by raising monetary conditions, tightening them in the US, maybe the Bank of Canada does not have to worry about matching the Fed.